about a 0.5% fall for the Nifty, as well for the Sensex.
Selling which is coming through. We're down about 80 points right now off the highs. Recovery is getting sold in. There is selling which is coming through. We're down about 80 points right now off the highs.
The market's down quite a bit. In fact, the market's breaking down now. 99.50 is gone on the index. It's been a weak day, like we pointed out. 200 points down on the Nifty, 684 points down on the Sensex.
The rally ahead of the Fed meeting sees profit-taking globally. Nifty and Sensex tank 2% each.
Banks behave like high beta, fall more on likely telecom dues. Nifty Bank tanks 3%, PSU banks fall the most.
Telecom stocks under pressure as the Supreme Court strikes down the AGR demand, adjusted gross revenue demand of over 5 lakh crore rupees against PSUs, but seeks an undertaking from telecom companies to secure payment in a staggered manner.
S&P keeps India's rating unchanged with outlook stable, says rating will be pressured if growth doesn't recover from 2021 onwards.
And gold is a standout performer globally, and thanks to that, Manappuram Finance rallies 2%. Well, profit-taking globally was evident. The Nifty and the Sensex ended at 1 week lows. Hello and welcome to Markets Today, the show where we will tell you all that happened in those 6 hours of trading, actually, in 5 headlines. I'm Latha Venkatesh, with me my colleague Prasant Nair.
Latha, hi. Just about 20 points off the lows today. I mean, so pretty much you'd say on a big day like today, at the lows, really, for all practical purposes. So not a good day for bulls. You'll hear all of that. We'll tell you what happened on stocks. We'll get your opinion. Sanjay Shah of Morgan Stanley with his view on markets. We also have Andrew Wood, director at S&P, after they reaffirmed their rating on India yesterday evening. Thoughts from him. CEA, India's chief economic advisor, KV Subramanian, with his views on what the S&P has done and what's the road ahead on reforms here in India. On the corporate opinion front, you'll hear from Varun Berry, managing director of Britannia Industries, talking about whether the surge in demand that they've seen in the lockdown period is likely to sustain or not. So all of that lined up here over the next 30 minutes. As always, let's spend 2 minutes looking at the day itself. Latha.
Well, it was perhaps the rally for the past 8 days. The Wall Street indices have been rallying, global indices have been rallying nearly on the expectation perhaps that the Fed would give them some manna from heaven, which they got. It was an extremely dovish FOMC, and that obviously was a good occasion to take profit. Some people are interpreting the profit taking also as triggered by the Fed's observations that, up until 2022, they don't quite see any reason to increase interest rates, and you keep interest rates at zero when you don't see too much growth. So that is another reason why perhaps the profit taking was triggered. But any index you pick globally, it was down between 2 and 2.5%. So it wasn't as if we were rank underperformers or anything like that. But perhaps in India, there was a bigger reason why the fall got accelerated after the Supreme Court's hearing in the telecom companies case, or what you call the AGR case, adjusted gross revenues case. There, the court observed that 20 years is a very long time to get all the back payments from the telecom companies. That could have been a bit of a jolt, which means they have to make the payments a little earlier. That could have been a bit of a negative. But beyond telcos, there was a lot of other stocks also that moved violently lower.
A lot, Latha. I just want to make 2 points before I get into stocks. So, at today's low, Latha, which is 9,885, we basically hit that much tracked level, which is the 50% retracement of the fall from the Feb high to the March low. That number comes in at 9875. Today's low was 9885. So again, 6 points away. So you can say we got to it and then bounced about 20 points or so. So that's point number one. The other 3 factors that I want to put out is, and it's up in the air, but the Fed was extremely dovish. But if you look at the dollar across and how it traded across currency crosses in Asia, the dollar strengthened. A dovish Fed did not push the dollar lower. That's point number one. Probably the market focus was on the downbeat growth forecast which the Fed put out. And number 3, I'm increasingly hearing more chatter, from guests we speak to and what I read as well, and as far as the second wave of COVID cases in the United States is concerned. So, just a bunch of points that we will need to watch out for. I mean, at this point, it just looks like routine profit taking, although it was a big one. But we'll see. In terms of stocks, let me just quickly run through what happened. PSU banks, Bank Nifty, metals, auto, pharma, private bank index. These basically were top of the list in terms of losers. I mean, pretty much all of them high beta names. The Nifty large cap losers, Bharti Infratel, Z lost about 7% or so. There was that Bank of America downgrade which came yesterday morning. I mean, the stock has lost about 10% from that point. SBI was down. Sun Pharma, Tata Motors, Maruti lost about 4%. Eicher, Bajaj Finance, Grasim, ICICI Bank. So, I mean, a bunch of these stocks which had pulled up, which had gone higher, saw pullbacks continuing. Broader losses, Indiabulls Housing, Ujjivan, Century Textiles, Engineers India, AU Bank, which had come up back to almost the 500 rupee levels, is back to about 460. And Aavas Financiers, another MFI, which continues some more profit taking. Latha.
Okay, well, thanks a lot for all those color. We will get you expert market opinion as well. The market rally will be driven by developed economies. That's the word we got from Morgan Stanley's co-head in India, Sanjay Shah. Sanjay, however, does see a lot of opportunities to make money in the Indian markets, especially in companies which are abetting the digital transformation. Listen in.
If you look at the last 10 years, emerging markets have not really lived up to the promise that has been kind of ascribed to them. And when you look at the current situation right now, it's really the developed economies which have been able to kind of combine all the things in the sense fiscal stimulus, enormous amount of liquidity infusion, and that's where the COVID curve also seems to have kind of peaked and flattened out. So my point out here is that the rally is being driven and will continue to be driven by the developed economies. So we like India, we like China, we like Russia. So we like some of the larger economies within the emerging market basket. And we think that the demographics out here, we think that the prospects for the growth to recover, albeit back-ended, is there. So it's not that it's curtains for India, so to speak. I think India can do very well, particularly for those companies which are able to adapt technological innovation and disruption, which are able to, which are going to be able to enable other companies to do so. So it's going to be a tale of two cities. There will be companies which will kind of transition to the new business model. They can do very well and they can add a lot of value to the investors, and the others which will fall by the wayside. So the overall index itself may just move at a modest pace, but a lot of opportunities to make money in India.
Okay, that is the view coming in from Morgan Stanley. Well, we move on to the second headline today. Banks, of course, the high beta space, behaved like high beta and fell more than others. I mean, there was a bunch of issues. The market was under pressure. There was profit booking, but there was also the telecom story, which played out for about 2 hours or so with, I mean, things remaining inconclusive. The index, the Bank Nifty, the private bank index, the PSU bank indices all fell between 3 and 4%. I mean, Latha, so this is again something which we put up every day, but I mean,
exactly. I have nothing to add
up and down.
I have nothing to add to what you said. I was expecting a bit of an outperformance from PSU banks because of the S&P reaffirmation of of India's BBB minus status, because banks are the ones that normally go out and borrow. So it was important. There was a mild outperformance in the first hour of trading from the PSU banks, and that was expected. But thereafter, you know, this global fall kind of enveloped everything. Yeah. Even the rupee did not strengthen. It should have, given the S&P performance, S&P reaffirmation. But because globally all EMs were taken down, risk assets were taken down, rupee also weakened, and therefore, you know, the bank stocks very, very quickly lost what they had gained in the early part of the day. And of course, what you said about the courts was very important. The banks are big lenders to telecom companies, and the fact that the court observed that you can't take 20 years to repay was yet another reason to sell off bank stocks.
Well, Chief Economic Advisor KV Subramanian said that he does not foresee any capital infusion for banks this year. I mean, that can't exactly be construed as positive. How much negative? Well, I think banks and investors were listening. Listen in.
What is, underlying here is the thought that, because of some of the productivity improvements, growth would improve. And so some of the fears of non-performing assets that we are actually thinking about, once growth picks up, that may not be as much of a problem. That said, the government remains committed to supporting as and when required. But at this point in time, actually, I don't necessarily foresee significant infusions, at least for this year, because of the way that this has been structured. Secondly, it's also important to keep in mind that, compared to the Basel norm of 8% of capital adequacy, our banks, on average, the CRAR is in excess of 13%. So that's a cushion of almost in excess of 5%. So there's something to keep in mind too.
All right, so that was the Chief Economic Advisor weighing in on banks. He gave us a slight hope that some privatization of public sector banks will also be considered, because the government broadly wants only 4 companies in every strategic sector. So that hope was also there, but you will get to hear more from that interview throughout the day. The third headline from Dalal Street today, telecom stocks. We've been speaking about it. They tumbled between 3 and 13% after the Supreme Court observed that telecom companies can't be given 20 years by the DoT to pay up the back charges of adjusted gross revenues. The court, however, gave some relief to public sector companies which have telecom companies and have been slapped with huge bills. Ashmit Kumar, our legal expert and courts reporter, is here with all the details. Well, a dramatic day in the courts, Ashmit. First virtual hearing in this very high-profile case. But anyway, tell us all the important fireworks.
Right, so a pivotal day as far as the AGR hearing is concerned. The hearing, which lasted today 60 minutes, can clearly be divided into 2 halves. The first half belonged to the issue of demands of 4.28 lakh crore rupees that have been raised against the PSUs. Now, the Supreme Court took particular exception to this. The Supreme Court, the language that they used was, what is this nonsense? That's the word used. What is this nonsense being done in the name of our judgment? The Supreme Court, Justice Arun Mishra-led bench observed that they never made a reference to PSUs. The issue of PSUs just did not arise, that the PSUs have been issued licenses which are dramatically different from access licenses that have been issued to telcos, and hence they just find it impermissible to have any demand raised against the PSUs. And with that, the Supreme Court has unequivocally directed the DoT to reconsider its demands against the 4 lakh crore rupee demands against the PSU. So again, strong language being used, slamming the DoT and directing them to revoke the demands. That's the first half. The second half, of course, was with respect to the telcos. Now, the issue that had come to light was the DoT's proposition to allow a staggered formula of 20 years for the telcos to put forth their dues. The question that the Apex Court has raised are twofold. The first question is, what exactly is a reasonable period? Is 20 reasonable? Is 15 reasonable? That is the first question. What is the benchmarking of a reasonable period? The second question that has been raised is that 20-year period, it needs to be secured by some kind of undertaking, some kind of guarantee. The Supreme Court proposed that perhaps the directors can come forth with personal guarantees, perhaps bank guarantees can be issued by the telcos. Are there other securities that perhaps telcos can furnish? These are the questions that the Apex Court has raised, that for them to consider a staggered payment payout, they have to have some degree of security to ensure that the government's dues, that the government's demand of 1.43 lakh crore rupees is secured, is protected. So towards that end, telcos have been asked to come back with a reply on how they can perhaps go about securing this demand that has been raised by the DoT for a staggered payout. That question is to be considered on the next hearing, which is June 18th.
Okay, that's pretty comprehensive, Ashmit. Thank you very much for that. So, but, in a limbo till the next time Supreme Court hears this, we'll see what the DoT submits in terms of its response to what the court has asked, and where the court takes it from there and issues directions. It's time for a quick break here. We are back quickly on the other side with more stories, more headlines, and of course, more opinion. Welcome back. You're with us here on Markets Today. We're running you through the top stories and the opinion. We got through 3 of those top stories. Here's the 4th headline. Ratings agency S&P has reaffirmed India's rating at BBB-. This is a big relief, as many were fearing a downgrade, with several economists and brokerages predicting a between 5 to 10% growth contraction this year. However, Andrew Wood, director S&P Global Ratings, has said that the rating will be pressured if India does not recover its growth rate from 2021 out. Listen in.
Our forecast for the deficit this year is 11% of GDP. If it surpasses that, and if it surpasses that by a long shot, then it's something that we would continue to look at and to analyze. But I also think what's really important is probably over the medium term here to see that there's going to be a very deep and a very large fiscal deficit this year. But will the government be able to pull back on its fiscal deficit next year, assuming that there's going to be this economic recovery that we're forecasting? We would expect for the deficit in that case to go below 10% of GDP, where the central bank perhaps purchases a special bond or some sort of instrument from the government for a period of time with a shorter maturity date. In some cases, it's about 6 months long, maybe 12 months, with the idea that once that instrument matures, then the government will go back to the commercial markets. That's something which is a developing trend, I guess you could say as well, in the EM space. But again, we haven't seen it yet in India.
Well, once again, we refer to the Chief Economic Advisor's interview, K.V. Subramanian. He spoke with us, as we said earlier, and said that S&P's decision will help smoothen Indian government's efforts to list Indian government securities on global indices.
One of the key aspects that that we were conscious about is the move that was announced in the budget to list the Government of India securities as part of the sovereign bond index. And now the S&P coming and basically continuing to hold the rating as it was, and with no change in outlook either, smoothens the way for the Government of India securities to be listed in the bond indices. And that will, as I've mentioned earlier as well, will bring in, supply of money into the domestic, Government of India security markets.
Okay, that is the Chief Economic Advisor weighing in on the possibility that probably after what the S&P has done, it becomes easier for India to list its government securities on global bond indices. Let's move on to the fifth and the last headline then. Gold has been a standout performer this year. In fact, its double-digit year-to-date gains have outpaced equities and other safe haven asset classes during these times. Stocks like Manappuram Finance, which are direct gold plays, benefited and they were up in trade. My colleague Manisha, though, is here to tell us what is happening in the underlying gold market. Manisha.
Well, 2020 until now has been gold's time to shine. We are up nearly 15% in the dollar terms, 20% up in the Indian markets, and this is on top of 25% gains that we saw in the previous year as well. Well, the latest boost comes in from the US Fed announcement, where they have come out with numbers on GDP and unemployment, and the fact that the zero interest rate regime would continue through 2022 as well. In these kind of scenarios, gold tends to do well, and that is what the markets are anticipating from these kind of levels as well. In this year, we have seen gold hit all-time highs in rupee terms, in other currencies like euro, Australian dollar, and various other currencies as well. Well, it's not just about COVID-19 and the expectation that we will be looking at weaker economies for much part of this year and the next as well. It also is about unprecedented stimulus measures that have been released by various global central banks, the low interest rates. This also is a US presidential year, and ahead of that, there is a lot of choppiness into the markets that is supportive for gold also. And then it has been about the weakness in US dollar. The dollar index is trading at a 3-month lows. That in turn also is supportive for gold. The analysts tell us that once $17.35, $17.50 per ounce on the higher level breaks successfully, we are looking at levels of 1,800, 2,000, take your pick in the next 12 to 18 months. There are a lot of bullish bankers and brokerages out there telling you that this is a good time to be in gold, because there is way more bullishness expected into this one from here on as well.
Okay, thank you very much for that explanation, Manisha. So more bullishness expected in gold. Well, here's another CNBC TV 18 exclusive. India broke a lot of biscuits during the lockdown. But the biscuit king, Varun Berry, whom we spoke with today, the managing director of Britannia, said that this kind of an upsurge in demand that one saw during the lockdown months of April, May, June is unlikely to continue. But he said that overall demand for FY21 for biscuits could be at least 3 percentage points higher than the demand for biscuits in the pre-COVID period. Listen to a very interesting conversation.
What we are seeing, we should enjoy. It's first of all, it's a momentum that we haven't seen for a while. So we're enjoying that, and we are doing all our best in terms of execution to make sure that we get this as high as possible. People will get back to normal life, and as they do, everything which they've missed during this period, which is street food, which is going out and eating in restaurants, etc., is all going to be back. So I don't think it's going to remain where it is for sure. It's very difficult to see where trend lines will go. I would think that certainly, 300 basis points better than what we were at pre-COVID. And but then the unpredictable animal in this is what's going to happen to the economy. If the economy sustains, which I think it will down the line, 2 quarters later, we should be back to where we were. And then I think we should be able to, sustain at least a 300 basis points increase over the pre-COVID levels.
Okay, so I mean, net, post-COVID compared to pre-COVID, Varun Berry is saying they should be about 300 basis points higher. So I mean, that's good news for Britannia and the stock owners.
And its investors, yes. Well, with that, we wrap up on this edition of Markets Today. Thanks a lot for watching, but don't go anywhere. There's a lot lined up for you.